Hi everyone, thank you so much for joining us today for our webinar, The 411 on Credit, part of our Money Foundation series. My name is Kelly Schweppe and I'm the Program Marketing Specialist here at General Electric Credit Union. We're so glad you've joined us as we have a lot of great content ahead. Thanks to technology, we're excited to be able to connect with you on such a great topic and wanted to thank you all for tuning in from the comfort of your home, work, or wherever you may be. And with that, I'm going to turn this over to Todd Moore with Trinity Debt Management to introduce himself and teach us all about credit.
Well, thank you so much, Kelly, and thank you for everyone joining the call with us today. I also want to say thank you to General Electric Credit Union for hosting today's event. I'm Todd Moore from Trinity Debt Management. It's great to be back with everyone again. Today is one of these topics that I absolutely love. And I hope that we do have lots of questions afterwards. And please submit those either through the chat or submit questions to Kelly, and I'll do my best to answer those questions as we close. But today I wanted to give you a broad overview about credit, its implications. We'll talk about credit scoring and some debt management strategies. So we have quite a lot planned for you over this next hour. But today's presentation is really focusing, it's kind of a deep dive into credit and to give you a really strong overview of how credit functions and ways to improve your overall credit capacity. A couple things as we get started. I thought it would be interesting for us to look, to take a step back from just credit scoring and those sorts of things and just look at this concept of credit for a moment. Credit is this wonderful tool that allows us to finance things that we would not otherwise be able to finance simply with cash through time. And these are things that we all know well, whether it's a home or a car, that we're looking to obtain a mortgage, private student loans. I mean, we've got so many different options for credit, personal lines of credit, all those sorts of things. But credit, what a wonderful concept. We think about that economically, allowing us to be able to finance things through time. So as we get into today's discussion, we're going to really kind of dig into what scoring looks like and really cover that topic, I think, well this afternoon. Now, we're still in this context of COVID-19, and I've listed here, these are some of the things that I'm seeing here at Trinity, working in the credit counseling area, where again, we've seen folks that continue to struggle with just being able to pay beyond minimum payments. We see lower capacity, that is lower scores at this point, because folks have either had a job loss or someone in their family has had a job loss. Maybe they've used credit to kind of move their family through time, that is pay bills, keep the lights on at home, those sorts of things. We've had to rely on credit to get essentially as a supplement to our income. But there's other consequences as well, whether or not that distracts from our contributions to our 401k or investments or other types of retirement, IRAs, those sorts of things. So credit has a lot of implications, not only for how we build credit and what access to the credit market is offered to us, but then also when we think about how credit functions, our ability to finance things through time, things that we need now, whether it's education or home, all those sorts of things that that essentially is part of becoming middle class and growing wealth. So it has a lot of implications. It also has a lot of implications, as I've indicated here, that whether it's insurance companies, credit scores run a whole range of things. We'll talk today about the scoring model, but there are many variations on credit scoring. So there's bankruptcy scores, there's insurance scores, there's scores that the credit union will use. We're going to cover today the model that I think is the underlying model for most of these kind of risk assumptions or credit scoring assumptions, but just wanted to provide some of that context and some of that background, really thinking about this idea that credit has such broad implications for so many other parts of our lives. I thought it would be interesting too, since we're talking about this kind of broad context for credit and how it functions, just to give you kind of a quick overview of the evolution of credit and the credit market and scoring and how that functions. Oftentimes, I'll get questions about, why is there 3 credit bureaus? How do we settle on 3 credit bureaus? What does all that mean? And I'll do my best to answer that briefly. When we think back, really, evolution of risk has been around for a long time. Equifax, I believe, goes back to the early part of as far back as 1899 as a company, but by the 1920s, they were already doing work to evaluate consumers and aggregate data, collect information on folks, whether or not they're going to be able to repay debts, that is, the likelihood of delinquency or default on some type of credit. And then much later, we get into some of the other credit bureaus. But this idea of risk itself, it's been around for a long time. And it even goes back much further into England, where they're looking at making risk assumptions, and people used to kind of gamble on this idea of risk. But that's another story. But thinking about consumer credit, it has come a long way. We think back to the early part of the 20th century, we're 1920s, and we have all these different businesses emerging, small business lines of credit. You would basically have a number of businesses that would come together. They'd share profiles about individuals and determine whether or not folks were credit risk. And then the business really takes off from there. Equifax is one of the big companies that starts to take this as a business model and determine, hey, this can serve a lot of institutions, banking and otherwise, insurance. Maybe we should make this into a business. And that's really the foundation of Equifax. But it starts off with just small lines of credit. And then as you see here, we move our way up eventually into this idea of regional credit bureaus. So on a regional basis, we go from just small community-based assumptions to we move up to those larger. And then we get into kind of regional blocks, different parts of the country looking at how this functions in a regional level. And then it kind of evolves to this national model, particularly as we think about World War II, post-World War II America, the 1950s or mid-century America, where folks are coming back and they're looking to buy a car or refrigerators, and the whole era of consumerism that takes place in the 1950s. That pushes this evolution of the consumer market forward. So it's kind of an interesting story, particularly for folks like me who are just, kind of fixated on credit and how it functions. But I'm hoping that gives you some background as well, just understanding, how the credit market actually evolved and what that means. So you fast forward, we have some companies that emerge. Like I said, Equifax begins to collect information on a national level. It's continuing to expand in the 1950s with consumerism. And then by 1968, you have another company enter into the market, which is TransUnion. And then TransUnion, also similar approach, national model, looking at information, trying to collect information that they will sell to banking institutions, insurance companies as well, making assumptions about risk. That is, again, looking at a consumer, their likelihood of delinquency or default. Much later, we'll get into folks who start to question consumer credit in the 1970s. 1970s is an era where there's a lot of emphasis on kind of consumer protections, and you'll start to see this in government generally in the 1970s. But one part of that argument in that context of the 1970s is the Fair Credit Reporting Act. Now, this is significant because it's still lasting and with us today. This is one of the main federal laws that govern so much of the credit market, and you'll hear about this over and over again. But a couple highlights here, particularly as it comes to accuracy and accountability. So, here, protections for accuracy holds credit reporting agencies accountable. So we want accurate information, timely information, because again, if that information is not accurate or it's not pertinent to you, that affects your ability to get the loan that you need, or a business line of credit, or just credit generally. So we want that information to be accurate, and we also want to hold the consumer credit agencies accountable for it being accurate. Requires the bureaus to be responsible for integrity and for data and how they store that information. Now, we'll continue to hear about security breaches occasionally that come up, but there are many, many safeguards that are built in, not only into the banking realm, but also into the credit reporting agencies themselves. Not to say that it does not happen, but there are multiple layers of protection that are there to protect you as a consumer. The other thing is you have the right to look at your own records and dispute reporting errors. So you'll hear about this a lot. Think about later this afternoon, we'll talk about what's called a soft inquiry. So that is tied back again to this idea of the Fair Credit Reporting Act. So let's say, for instance, that you wanted to sign up for a service through Equifax that allows you to obtain your credit report. That's part of this idea, having the ability to review your records, make sure that it's timely, make sure that it's accurate, and also when there are problems with the credit report, that you have the ability to dispute those items. So we'll see that later this afternoon as we get into scoring and how that functions. But certainly many of us have either disputed items or not. That ties back to the Fair Credit Reporting Act. It also requires creditors and businesses to report their data with accuracy and to respond in a timely manner. So you'll see when you've made a request or to dispute an item, that the Bureau has to, it's usually between 30 and 45 days that an agency has to respond. Make certain that that information is timely. That timeliness matters because you need a loan. And you also want to, and it's also an additional way to hold the Bureau and others accountable for making certain that that data is correct. Again, a couple highlights here from the Fair Credit Reporting Act itself, and you can see it's been amended many times. And the most recent, I'll go through a couple of highlights. Won't spend a lot of time on this particular slide, but I thought you might find it interesting. So you can see here this notion of early 70s correcting records, being able to have accurate. 1996, that 30-day rule starts to kick in a different and a more focusing again on accountability. In 2003, it was amended where we call it the FACT Act, Fair and Accurate Credit Transactions Act. Free credit reports in 2004. Now, this is part of that annual creditreport.com website. Again, making it easier for us as consumers to obtain information, to review information. And then we also get into, most of us are well aware of what happened during the Frank Dodd era, where we had the housing crash here in the United States, even globally. But these are some protections that I thought you might be interested in. As late as 2018, we had where you could put a security freeze or a fraud alert on the credit report. Again, I'm providing this context because so much of what we'll talk about later, you'll hear about certain factors of a credit score or disputing certain items, or you may talk about obtaining, an annual credit report, all those sorts of things. This is that legal structure that's behind things that we don't talk about often, but it provides that legal background and that alignment to some of the work that we're talking about today. So it gives you a nice context for how the credit market evolved, how it's structured, and kind of some of the legal framework around credit scoring and accuracy of timely information when it comes to lending. So I hope that is helpful. Again, this question about the three bureaus, I thought you might find this interesting. Just a couple quick facts for you. Equifax, again, 1899, begins to expand by 1920. TransUnion, 1968. Their company was founded in 1968. And then 1996, Experian enters into the market. And one that I'm often asked about, which is Credit Karma. We find that one emerging in 2007. So we'll talk a little bit more about the bureaus and Credit Karma here in a moment, but thought you might find that interesting as you think about this question of why is there 3 bureaus and what do they do? This next slide, I wanted to give you kind of a framework to do some work. And what I mean by that is, if we think about ways to improve our credit score, our credit capacity, this provides a nice framework. It's a very practical way, and I've shared this before in some of our presentations before. So if some of you have seen that before, again, I'll cover it now, but for those who are new on the call, the framework that I provided here, it gives you a couple steps where, it takes the abstract and makes it more practical. That's the way I think about this framework. So if you're thinking, abstractly about credit scoring and factors and all those sorts of things, I'm going to try to simplify some of that for you now, and you can align that around this concept or this framework for credit building. And hopefully that will give you a good guide for how to do this work long after the call. So if you were to log back in and listen to the presentation, this framework, kind of a practical way for you to actually improve your credit capacity. And you'll see there's basically 5 steps here. We're going to cover those today. But I'll walk you through these. Consider the goal. We're going to talk about each of these individually, but these 5 steps really provide a very practical way for you to strengthen your score, take a score that maybe is stagnant, maybe it's not moved in a while. Think back again about COVID-19 and its impact on us economically. Maybe you just need a little more work. Maybe you have someone at home that you're working with where you're trying to maybe build their credit. This framework will work for them as well. Maybe you're planning a major purchase and you're just figuring out, hey, I'm a few points shy. I'm trying to work with General Electric Credit Union. What can I do to really strengthen my score? So it's got a lot of implications here for how this works, but I think it's a very practical way to build credit capacity, strengthen your score. So I will go into those factors now. First thing I'm going to have you do is to really think about, just taking a moment to sit there and kind of relax through this idea of credit building and really pinpoint what it is that you're trying to accomplish. What are your credit goals? Your short-term, long-term credit goals. What is that? What does it mean? For instance, are you looking to buy a car here soon? Do you need a personal line of credit? Are you trying to do something with the home? Do you want to become a homeowner? What is your overall credit goal? We need to know that, because that allows us to create a strategy that's specific to that particular goal. Obviously, a car loan is one thing. Having the credit capacity to purchase a home, well, that's a very different challenge. So we really want to think through first, what is the goal? What are we trying to accomplish? And then secondly, what we would do, working with General Electric Credit Union, and we can do this to help you as well as a partner, Trinity Debt Management, what we can do is we'll figure out the products and services that you need to reach your goal. So all of this work is aligned. We try to our best ability to create a strategy for you that allows you to align your budget and your finances to the credit goals that you need to accomplish. So we'll figure out the right products and services to do that. And wanted to give you just a couple things to think about here, kind of action steps to get you started. So obviously you can always speak to someone at the credit union directly. Pick up the phone, talk to a loan officer. Ask them about. This is one of those questions you can say that I nudged you to ask. What is the minimum score requirement? Okay, so you may want to know that's going to be very different for a car loan than it may be for a home loan or personal lines of credit. But you want to dig into that question. Speak with someone, talk to a loan officer, and let them know, hey, I've been attending the seminars, got a couple questions for you. They're going to be able to help you. But again, identify the goal and let's figure out a strategy to achieve that goal. Now, on the credit reporting side, I can always help you. And again, all of our services for members of General Electric Credit Union are going to be free. And I mean free. There is no hidden charge or anything else. I'll pull a credit report for you. I'll identify your base score. We'll look at your scoring objectives. And then I'll align. We'll do we'll do the work to align our strategy to reach your goal. And then lastly, we're going to have to really create a timeline. You know, one of the hardest things that I tell folks, they'll say, well, you know, if I pay off my debt today, am I able to get the loan? Well, maybe, maybe not. And in most cases, if our score or our credit capacity, just our ability to obtain a line, say we've had late payments, or we've had some outstanding debts, and we just need, you know, if we're 15 points shy, that's one question. A few points below what we need is another question. So long story short, when we're thinking about doing this work, we have to really establish a timeline, because we cannot buy time. That's one of the hardest conversations sometimes to have. And what I mean by that is just simply paying a bad debt doesn't mean that tomorrow it translates over to the score that we need. It's a little longer term than that. So we'll get into that in a little while, but something that I want you to think about is, if you're looking out and these are something, and your goal is to do X, whatever it is, car loan, personal line, whatever it might be, factor in time, because we've got to have time to build your score to obtain the product or service that you need. Now, the next step is for us to think about, just let's dive into this credit scoring question, okay? And I've given you some context, about this, but the three bureaus that are relevant to today's conversation really are Experian, Equifax, and TransUnions. Those are the three major bureaus. They each are going to produce different scoring ranges, so you'll see that each score is going to be a little bit different. You know, when you're thinking about that market, again, if you say, okay, I've looked at one credit score, why is my credit score X? You know, I've got a 650 or a 720 on an Equifax score. Why does it look different when I look at Experian, TransUnion? I'll show you that in a moment. But basically, it's differentiation. You know, I mean, the model functions mostly the same, predicting risk, delinquency, and default. But they have a different starting place. Their numbers are a little different. But when you work with a credit union, particularly in the housing realm, they're going to do what's called a tri-merge. So they're going to look at all three. They will factor those, and there's a mortgage model that will be used. That, you know, there's where you can ask the question, you know, here, what is my minimum score, and what do I need to do to qualify for a home loan? And that's that conversation that I'm hoping that you will have long after this call. So a couple other things on this slide when we think about scores, and we're going to dive into scores here in a moment. But just for context, again, you know, we think about Fair Isaac and Company. 1950s, we're back to that mid-century part of the 20th century, post-World War II. Fair Isaac and Company, I believe these two gentlemen, Fair and Isaac, that's their last names. One was a mathematician, and I forget what the other one did, but they were both high math minds. Let's put it that way. And they determined, they went through and kind of took up where companies had aggregated all this information. They put this into statistical models. So Fair and Isaac applying that math and applying, they really put statistics behind the model. And that's where you see FICO. So before we have all this aggregate information, we have all this data, what do we do with it? Fair and Isaac, where they fit into this puzzle is they structure all this information into a model that can predict, based on factors, the likelihood of a consumer, for us, how we might handle a line of credit. So they really applied math to that question. It's really remarkable. But we'll get into that FICO score here in a few minutes and how that functions. And then lastly, I talked about Advantage Score. Now, that goes back to our friends at Credit Karma or Credit Sesame. Key point here. This is not used, the Advantage Score, while it is a variation on a FICO score, which sounds kind of confusing. That is to say that it uses the same 5 factors to predict risk, but it's not, the model is not exactly the way it's designed as a typical FICO score. It's mostly for education purposes. So if you're looking at Advantage Score and using Credit Karma or Credit Sesame, you may have already run into this, but you would say, okay, I pulled a score. Why is it different than, say, an Equifax score? Well, the models are different, and no lending institution uses the Vantage score. So that's something I want you to be aware of, and I'll cover that more in a few moments. But step 2 in this process, as we think about how to use this model and make it as practical as possible, we know the goal, we figure that out. Now we're going to dig into the score and how that functions. So here is a good overview for those who are interested in these kind of variations on FICO and Vantage scores to really try to highlight the differences between these two approaches. So you look at a FICO score, you look at a Vantage score, and you say, what are these fundamental differences? Again, I mean, I'll point you over to the Vantage score for a moment, that third bullet point. FICO, the Vantage score I've seen in practice, and this is documented as well in literature, but there's about a 30-point swing, positive or negative. So it can be very misleading with Credit Karma. You'll look at something and you'll say, wow, I think, why didn't I qualify? My Credit Karma score or Credit Sesame score says that I should. Well, again, it's mostly for educational purposes. It allows you to monitor things that are maybe inaccurate or take it, it just doesn't function the same way as the information doesn't function the same way as what we get from the 3 major credit bureaus. So all of that to simplify to say this, as we're doing this work, I'm going to try to shift you from using the Credit Karma information to really get you to focus on what's being done with the 3 major credit bureaus. That's one of those kind of shifts that I think that you need to make. If you're going to do this work, do it right, okay? And really, the 3 major credit bureaus, those are the bureaus that are going to be used for lending purposes. So let's dig in and really figure out what it is that we need to fix there and kind of move away from using or relying on Credit Karma as much and focus on the 3 major bureaus. But again, fundamentally, what we're trying to do with a FICO score is we're trying to predict the likelihood of delinquency or default. So I'll show you this in more detail. Notice we've got the Beacon score, the 300 to 850, which is what I'm going to cover today. And then you'll see you've got a couple other variations here. So you've got the TransUnion and Equifax, the TransUnion and the Experian scores. Notice the math. It's in a little different starting point. So 300 is what we're talking about today, 300 to 850. That's our baseline. That's where they start. But the model that I'm going to cover today for our purposes is the Beacon score, which is the primary score that's used for most lending institutions and lending decisions. So essentially, when we look at this model, you're going to have five factors that make up your score. So your payment history, outstanding debt, credit history, inquiries, and types of credit. I'm going to cover each of those for you, but when we're thinking about this and we go back to this framework, know the score, I'm going to challenge you with this. Why is my credit score X? Whatever yours might be. So you've pulled a credit report, maybe you purchased one or you had one pulled, and maybe the score just was lower than what you expected, so you were declined a loan. You finally got your score. Why is my score X? This is where you can really dig into this idea of credit scoring. Again, purpose is delinquency or default. We know we have to have a minimum score to qualify for certain lines of credit. So if we're short, what we have to do is we dig into kind of these factors. Is it a payment history issue? Is it an outstanding debt issue? What is actually going on here to keep that score below where we need it to be? Or you might even say, okay, I've done these things really well. That indicates why my score is higher. So we're going to dig into that now, but kind of going back to that question again, why is my score X? Whatever it might be. First factor here, and again, you can refer back to point value. This will break the point values all broken down for you in this slide, but I'm going to walk you through this first. This is one of the big ones here. This is the most important factor in your score. So when we're thinking about payment history, oftentimes we think about just timely payments, those sorts of things. Those are certainly important, okay? But this factor covers so much more. Take a look at that third bullet point. I mean, these are things that can do great damage to a credit report. So if you say, why is my score X? Why is my credit capacity weaker than what it should be? thinking about scoring, any of these sorts of things are really worst case scenarios. So bankruptcy, wage garnishments, judgments, any of those sorts of things. So all that activity leading up to a bankruptcy or a foreclosure or a garnishment or a civil judgment, all of that activity affects your payment history. And, those are those missed payments or late payments. So that has a very, very negative impact on the score. And then the opposite of that would be all these timely payments that are there being reported back. Again, shows consistent payment history through time. Those are all factored into your score. It's where you get the most point value, can have a tremendous impact on strengthening your score. Now, here's what to take away from this, because there's a lot of stuff on this slide. If you've had some hardship, whether it's COVID-19, whether it's just you lost some income, whatever the situation may be, we always want to look out at least 24 months and just really try to improve. So you're on the webinar today, and your score may be slightly lower than what you're hoping it would be. The idea is that you use this information to look out, and rebuild. So that's that notion of time I talked about before. And that will take us some time. It could take us 6 months. It could take us longer to really get to where we need to go. But there are no quick fixes. So it's important to really understand what's all packaged into payment history and how that works. If you've had late payments, you've had something happen, we really want to reestablish, starting today, we've got to reestablish payment history and make certain that's strong moving forward through time, because that's going to be one of the efficiencies that we'll use to kind of move that credit score up. That's one of the key areas. So take some time, read through here as well after our presentation. There's a lot in this slide, but looking at scoring, one of the most important factors is going to be starting right here, looking at payment history. So next thing we'll look at is outstanding debts. This is where maybe if your score is a little stagnant and hasn't moved, part of the problem is probably that we need to shift the credit debt ratio. Okay, so you may have made timely payments, maybe they're minimum payments, and we're still carrying high outstanding debt. So our score is just not moving. And that happens. It happens. It's a very common issue with credit scoring. FICO, which suggests to us, and this is what I would call the 30% rule, not a textbook term, but I call it offhand the 30% rule. So what we're aiming to do is, or what FICO would tell us, is anytime we carry beyond 30% of our available line of credit, that we start to lose points. It starts to diminish our score. Now, that 30% rule, you can take it, if you got a $5,000 card, 5,000 times 0.30, pick a card number, you just do a percentage on that. Anything that you're moving out on an increment beyond 30%, that's going to negatively impact your score. Now, this also works in totality. So it's going to look at all your credit card debt. It's going to look at all your debts. The model kind of weights some of your debts differently, and I don't have time to get into all those details. And frankly, FICO doesn't share all of that information with us. We don't know the secret formula, but we only know parts of it. But we do know, and they do tell us that certain things are weighted differently. For instance, student loans are weighted differently than a mortgage. Credit cards are rated differently than student loans. And there's a whole range of items. But the idea is, if we're looking at our outstanding debts, what we have to do is we start diminishing those outstanding debts. Once we get to 30% below, that's idea. We want to pay things off. Essentially, what we're trying to do is shift the credit debt ratio. That is, how much available credit do we have in total, and what is the percentage of debt that we're carrying? So 30%, anything that's moving out beyond 30%, we know that's going to have an impact on our score, a negative impact on our score. I'll highlight one other part of this slide, is the statute of limitations on debt collection. So I want to say this clearly, not saying not to pay your debts. But in some cases, when we're doing this work, if we pull a credit report and a bad debt is scheduled to fall off, say a year, maybe even 2 years, and it hasn't been brought for a garnishment or something like that, and you owe a lot of other debts that are active and open on your credit report, we'll probably let those two fall off if that's a significant problem. We may or may not focus our strategy on paying a couple of those debts off. We might let them fall off through the statute of limitation. Now that sounds a little odd, but here's the reality of things. We only have so much money, and we only have so much money to do this work. So these are all those strategic things that we work on through time. There's a lot of things that can go positive or negative around the statute of limitations idea. So I don't want to overstate its ability to solve all problems. And that's why I'm saying clearly that I'm not saying not to pay your debts, but we have to, this is where credit counseling and working together towards your goals can make a very significant impact on whether or not you obtain a line of credit over a longer period of time. So, if you've had significant problems in the past, whether it could be any range of things, I won't even go into that, but let's just say that there's been issues that have caused you to either have charge-off accounts or you had something significant happen along the way where you just couldn't pay debts. Let me work with you around that question, because we want to take the money that you have and use it to our fullest ability. We want to be as efficient as possible to use the money that you have to pay off or reduce outstanding debts. So in summary, just on this particular approach with outstanding debts, just keep in mind kind of a rule of thumb: anything beyond 30% on any card that you're carrying, as you move out, risk goes up. Therefore, your credit, you're going to be penalized, because the higher you go beyond, at least for credit scoring purposes, the further you go beyond 30%, the more likely you are to be in delinquency or default on that account. And therefore, your score starts to diminish through time. This slide here just gives you a nice visual. You can see utilization, your impact of your score. I won't spend a lot of time here, but you can obviously see that the idea is that the lower the lower the amount that you're carrying in terms of debt, that credit debt ratio, the higher the score, and vice versa. So it's just a visual to demonstrate that concept. Length of credit history. There's some rules here that I want you to follow, that FICO tells us that we must follow. So opening and closing accounts, not a good idea. And in fact, we can actually do ourselves some damage doing this. If you have any questions about what to close, or you're contemplating or thinking about closing some accounts down, and you're in the market to obtain a loan, either short-term or long-term, let's say that you're looking to borrow a substantial amount of money, whether it's business related or whatever the case may be, please pause and talk to us at the credit union, or reach out to me, and let's talk about what your overall goals are again, because let me explain how this works. So in order for us to do any kind of credit building work, that is to build that score, strengthen our score, improve our capacity, etc., we have to have active open accounts. So cash only out here in the market, just paying cash for everything, will not help us build credit. Okay, so we want to kind of shift and understand that we need active open accounts to do this work. Now, opening and closing accounts. When we think about opening and closing accounts, FICO will penalize us for closing accounts, because what we've done is we've removed part of the risk model. Okay, all of this goes back to that magic word, risk. Whether or not that I can have the ability to predict delinquency or default. So when you pull that out of the mix, you've diminished the ability of the scoring model to predict risk. So you're getting penalized for that. Opening a new account means you've just taken on more debt in many cases, or that you have the likelihood of getting into further debt, so you're penalized there. Now, the other thing to think about here with opening and closing, think back again to the credit debt ratio. If you close something out and you're carrying beyond 30% on some of your other credit cards or other debts, taking something that was already paid down out of this mix can actually look make the percentage look as if you're carrying more debt. So you can give yourself kind of a double whammy. You get penalized twice. Now, again, these are not arbitrary things that I'm telling you. This is what FICO tells us that we should follow to avoid being penalized. So take some time to kind of go back and review this information. Opening and closing accounts, generally a bad idea. I'm not saying that it can't be done or shouldn't be done, but in most cases, we want to be very careful as we're, particularly if we're applying for any kind of loan here, soon, because we want to make certain that we're not penalizing or creating a hardship for ourselves just by a very simple thing as closing an account down. So take some time to really think about that. If you have someone who is younger and building credit, I'll also have you looked at it. If you pull a credit report, you don't see anything there and they're younger, it's going to take 6 months to generate a score if you've never had any lines of credit. But we need active open accounts. That's how we generate a score. And if you're new to credit, it will take at least 6 months to generate a score. I had this very issue here recently with a younger person just starting college. They wanted to purchase a car and some other things, but no score to evaluate because their credit history was too thin. They're too young, and they just needed time to build a score. So a lot of information there for you. Inquiries. This will take us back to that context I mentioned before. So with the credit agencies and how, the Fair Credit Reporting Act and the FACT Act and some of those things, this is where inquiries comes in. I'll tie it back there again. Now, a hard inquiry, obviously, this is where, let me just say this, the distinction to make between a hard inquiry and soft inquiry, it's a pretty obvious distinction, because really what you're saying is, I want some money, I need some money. That's a hard inquiry. Soft inquiry is largely for information purposes or to review our scores. Sometimes with employment verification, they may pull a credit report, look at some other personal information on a credit report. That's a soft inquiry. Goes back again, both of these inquiries are always governed by the Fair Credit Reporting Act and the FACT Act, and being timely and accurate, those sorts of things. But this is where you'll see those protections really kick in, whether you're asking for money or you're having someone verify information or verify employment, those sorts of things through a soft inquiry. Again, the key distinction is that we, on one hand, anytime we're filling out an application for credit, we're asking a lending institution to loan us money, that's a hard inquiry. And those can have an impact on your score, particularly in the credit card market. Soft inquiry, that's for educational purposes, part of that legal structure we talked about before. No impact on the score whatsoever. So you can check that thing as often as you like, which, is important to check it, but, give it time to update at least 30 days as you're doing the inquiry process. But hard and soft inquiries, there's a rule called deduplication that I want you to be aware of. So basically, when you're rate shopping for a home loan, a car loan, or a student loan, there's where this rule gets a little different. So in the credit card market, if you're applying or someone offers you a free t-shirt or a water bottle or 25% off today if you open up this account or apply for an account, those are all hard inquiries. Those all count as an inquiry. Whereas a home loan, car loan, student loan, you can do rate shopping so long as those multiple inquiries are done within a 45-day period. So the old rule used to be you go to a car lot, drive a car, finance and insurance guy runs your credit report 8 times. Each one of those is a hard inquiry. That's not been the rule for a number of years now. And sometimes I'm still asked about that. Is there going to be multiple inquiries? Because folks will see that on their credit report, but it only counts as a single inquiry. So just some context there again about inquiries, hard and soft inquiries, and how this functions in your score. Rule of thumb here, stay away from inquiries that you don't really, if you're not seriously pursuing a line of credit, don't apply for that line of credit. Don't gamble on whether you'll get it or not, because then you wind up doing yourself a disservice. There's no need to have multiple inquiries on there. And I see this a lot. folks have a lower score. They haven't asked about particular products and services. They haven't talked to the credit union. They'll pull and they have multiple inquiries. That doesn't look good to lenders as they're looking for you, as you're looking out into the market trying to obtain lines of credit. Always reach out to us, work with us so that we can help you. If you have any questions about that, please let us know. And then lastly, credit mix. This is basically what types of credit do you have? Do you mostly have credit accounts, credit card accounts? Have you had a student loan? Have you had anything else on your credit report? Where this becomes important is just think back about risk again. If you're so leveraged just on credit cards and you haven't had a car loan or any other kind of loan, we might have to do some work on a credit mix to strengthen your credit capacity to obtain a home loan or to obtain a higher dollar loan. That's where this really becomes important. So we want to think about, a credit mix. If you get to the point where, you're looking to obtain a loan and you're thinking, okay, I've only primarily had credit cards, this is where we probably need to do some work to strengthen your credit mix so that you can have access to a higher loan. Again, go back to that word, risk. It's what it's all about. So what we're trying to do is have kind of variation here. And that's where I have a rule of thumb again for you. Develop this mix of you have some type of installment loans and revolving lines of credit, credit card accounts, student loan, some type of bank loan, something. You have this interaction between these various products so that you can demonstrate to a lender, hey, I'm ready for a home loan or a higher dollar line of credit. So that is a lot of information for you just on that part. Recognizing our time, I'm going to try to move forward a little quicker and get us into a couple activities where I call it get the good stuff going. So what does that mean? These are things that you can do, products, particularly I'll just highlight these products that you can obtain, okay? So secured credit lines, credit builder loans, or personal lines of credit. I've got a couple non-traditional approaches. I probably won't have time to cover in those today, so if you have any questions on those, let me know. But the secured credit card, if you have any questions about that, I want to encourage you to reach out to General Electric Credit Union. I'm not certain, between $300 and $500. So basically, you would put up money as collateral. General Electric Credit Union would issue a credit card up to that amount. The key idea around getting the good stuff going is using a secured credit line. One, it's an active open account that reports to the credit bureau. That generates payment history. That's the good stuff. We need that to get a score. And it also is absent a credit score. So let's say that you got a really bad score, okay? Had some significant hardship, things just didn't work out. I get it, okay? This is the perfect product for you because what this allows you to do is completely forget about having a lower score. We're gonna get the good stuff going. We're gonna have an active open account. We're gonna have a secured line of credit. We're gonna rebuild our payment history and strengthen our score. So a couple other things that you can do there as well is a credit builder loan is a smaller dollar loan, let's say $1,200, $1,500 that you would borrow and make payments over a year or maybe a little over a year. Again, getting the good stuff going means that I have active open accounts that are reported, that I also have timely payments, and that I have information that's being reported to the Bureau every month so that I can actually generate a score or rebuild my score. So, and that would work for a small dollar personal line of credit as well. So that's that idea of getting the good stuff going, is we want to make certain that we have active open accounts, that we have timely payments, and that we have something that's reporting positive to our report every single month, despite whatever problem we may have had, to really improve our credit capacity or to strengthen our score. The next thing I'll talk about just quickly, because we are getting close to our time, just some ways, this is just some ways to deal with debt, okay? Now, I am going to highlight this one point here, okay? Debt management is important and essential to financial security, but debt management alone will not serve as a credit building strategy. So what does that mean? So if we're just focusing on debts, okay, sometimes we get so focused on the debt management side, we're saying, okay, I just got to pay all this off and pay it down. Well, there are many cases I work with where folks really need to do two things. They need to get the good stuff going, that is, have something active and open reporting, say a secure credit line, okay? And then they also have to deal with debt. It's those two, you really want to have those two things happening at one time, because paying debts alone does not build credit. Now, oftentimes someone will have a hardship and they just say, okay, forget it. I'm not opening anything else up. I'm done with credit. It's over for me. I'm just going to pay cash. Well, go in and try to obtain a loan. That's not a very good strategy. So we're going to kind of move out of that concept and really talk about doing two things. One, again, get the good stuff going, build that strong payment history, have something active and open reporting, and then also look at our outstanding debts. That's those top two factors in our score. Since we're kind of short on time, I'm going to move right into these three debt management strategies, and then I'll probably close there and take any of the questions that you have. So along those lines, there's basically three approaches here when we think about debt management strategies. And I'll just go through these quickly. Credit utilization approach, interest rates, and rollover. We think about credit utilization, go back to my 30% rule. The idea here is to rank order all of our debts from lowest to highest, particularly credit card debts, because those are the ones that carry the most risk, and those are the ones that penalize you the most through credit scoring. So our idea here is to kind of rank order these from lowest to highest. And we're not saying we're paying them completely off, not at this first step. Our idea is to shift the credit debt ratio. So what we're trying to do is we'll focus on card one, monthly minimum payment. In addition, we've got X amount going. So let's say that, we go from a $35 payment to $85 payment, and we move that card down to 30%, okay? Then we go to card two, card three. So in totality now, we've shifted our credit debt ratio to where we only owe 30% of whatever the balance is on that card, where the total credit line is on the card. That's credit utilization method, okay? Now, it's an efficient way to use our funds to really shift the credit debt ratio and strengthen that score, okay? Credit utilization. The other approach that you can take is what we call an interest rate approach, where you would look at your highest interest rate and you really go after, some folks really get fixated on the interest rates and they want to pay down, and there's a lot of reasons for this, but they will focus on the highest rate card, highest interest rate, and they put all their effort into paying that down, okay? Now, there's a lot of good math reasons to do this, but I will tell you, it's slow to reduce your total outstanding debts or to shift the credit debt ratio. And from what I've seen, having worked 13 years in this area and dealt with all sorts of issues, I think that and the research literature will also tell you this as well, is fatigue and limited credit score improvement. So while there's good reasons mathematically to go this way, because you can save on interest, oftentimes it's a more complicated picture than just what I see through interest rates. So there are consequences with just focusing on an interest rate approach, okay? So but that is certainly a strategy when you have funds to make this work that you can utilize to shift the credit debt ratio or to pay off outstanding debts. And then we'll look at the rollover method. Lastly, when we're thinking about just doing this credit type work, here's what we're going to do. We're going to focus on basically, again, rank ordering from lowest to highest debts. And then the idea, again, is to, once we've gotten things paid down 30%, we're going to stay focused in paying a card off completely, and then taking that monthly minimum or whatever we were paying before. Let's say we went from $35 to $85. We're going to roll that $85 forward to that second card plus the monthly minimum that we're paying. So we're rolling whatever money that we have, since we're saving now, having paid off one of our debts, we're rolling that money forward to reduce debt 2, reduce debt 3, moving that forward through time around a timeline so we can pay off these debts and move that credit score up. Again, one of the consequences here, you can really see efficiency in the score. And we also think the literature would also argue that it's motivational because you get to see the impact through time. You know, incremental gains, it gives you, puts a little wind in your sail, gives you motivation to continue this work, which is extremely important. So I will close with this last slide, and then we'll answer any questions. You know, making all of this work count. This is this final step because we've covered a lot of ground today. First thing, again, thank you for joining us today, and please reach out to General Electric Credit Union. Let us know how we can help. Reach out to me here at Trinity. I can pull a credit report for you and help you along this journey. Do a lot of analysis to kind of strengthen your score, align your income, and align a strategy to help you go back to the credit union and get a loan. That's really what we're trying to do. If you need help with either rebuilding your credit or establishing credit, again, those are two very different questions, but we're certainly here to help you along the way, and would be glad again to think about strategies to help you achieve either one of those goals. And then lastly, again, just think about where you want to go and really what is your number one credit goal, or what is your credit goal that you're trying to aim at. If your score is lower, just understand it's going to take a little bit more time, but you can do remarkable things within 24 months. So even if your score is very low, I've given a FICO score of 520, which is on the lower side. I mean, we can move things a lot with being focused and following clear strategies over a 24-month period. That's not that long. It may sound like it is in some cases, but you'll get there before you know it. So again, I just want to encourage you, number one, to reach out to us at the credit union, or reach out to us here at Trinity Debt Management so that we can help you along the way. With that, Kelly, that has been an intense hour, so I will take any questions. And again, thank you to everyone who's on the call. Please let me know if there are any questions, and I'll take those questions now.
Okay, yeah, we do have a couple questions, so I do want to make sure we get to those, so we can jump right into it since I know we are approaching the 2 o'clock hour. But like I said, there's a couple questions, so let's go with the first one. It says, I had a home equity loan which I converted to a personal secured loan, and my credit score dropped 20 points. The balance was the same. I don't understand why the drop. Do you have any insight as to why that may be?
Home equity, and it was converted to a different line. So I will be honest with you, I'm not as familiar with conversion of how that functions, although generally what I would say is anytime, and this is what FICO would tell us, is anytime you modify any type of loan, moving it from one loan product or one approach to another, any modifications to any type of loan generally will have a negative impact. So it goes back again to this idea of opening and closing accounts, or any kind of modification through a loan generally in the short term will lower your score. I'm not certain in that equity line if you took a certain amount and you took on more debt through that approach, or how that functions. So I'm not certain how to address that exactly, but general rule is either modifying, going from an equity approach to something else, or any kind of changes. That in itself, in addition to FICO saying any type of new loan will have some negative impact, I would say it's probably somewhere in that realm as to why that was lower. The other thing there is I would look at that as a shorter term negative impact. So if the score was higher before, I wouldn't see, in the next 90 days, you should really see significant points reemerge. So you'll kind of take that negative hit, and then the points swing back upward. So it shouldn't be a longer term, unless there's something else that I'm just missing in the information that you've given. But those two factors generally, modification and the fact that it can be considered a new line, those two factors alone would result in a negative impact, but it should be short term.
Thank you. And then we have one more question regarding balance transfer cards to lower interest rates. Is that good to use?
Yeah, the balance transfer approach, there's a couple things to think about that. So if you're going to do a balance transfer, it's going to be credit score dependent. So if you're going to move those when you do a balance transfer and the score is strong and you're able to transfer a balance to a lower interest card, that's usually the result of you having strengthened your credit score and strengthened your overall credit capacity. So if you're able to take advantage of a balance transfer and go to a lower interest card, that's usually an indication, that's generally an indication that your capacity is stronger, that you've raised your credit score through time, and that's a market advantage for you to take advantage of, essentially. I mean, there you're able to pay off whatever balance you're transferring at a lower interest. That goes back to one of the factors we talked about today. That's part of that interest approach that we would talk about. So now instead of paying at X rate, you've got a lower interest rate. But again, that's credit score dependent. In this case, as you've described, I would say that's a result of you having a higher capacity, higher score capacity. So I would say that is positive. You'd want to take advantage of that. I certainly have worked with folks where we have done that before. We'll raise their score. And as they have strengthened their score through time, then we would transfer over and then pay that debt down at a lower interest rate. And the result is wonderful because not only have they saved money, but they've also increased their overall score. So take advantage of those opportunities. Where I've seen that go wrong is, and this is my only caution for you, is make certain that when you look at the balance transfer that you look at the details. So is it a teaser rate? That is, is the deal too good to be true? So let's say that you transfer something over, and for the next 6 months, maybe even the next 24 months, is it zero? What's actually being offered? There's so many different offers out there for balance transfers. What you don't want to wind up with is two things. One, you don't want to wind up having at the end of that period not paid off whatever you transferred, and then have a higher interest rate than what you have now, which I've seen many, many times. And then secondly, just make certain that as you do the balance transfer that you're disciplined, that as you do this, that the intention is to pay the debt off quickly and not get into a situation where you're assuming because you have a lower interest rate that now you can spend more and then you'll pay it off later. So you really want to think about how, what is your intention here? Be careful as you do the work is really what I'm trying to say. But otherwise, if you're disciplined and you are really aiming to take advantage of the interest rate and to pay that debt down, go for it. It's a good thing.
And then we did have one more question come through. We'll go ahead and end on this one. For the 30% rule, is it weighted the same from card to card versus average percent of all?
Yeah, it'll take your overall revolving debt. So it's not necessarily card to card. It'll be more 30% rule. In fact, we'll look at everything, but it'll weight home loans one way, student loans. For instance, if you're carrying $100,000 plus in student loans, you can still have very high score by making certain that your credit card debt is below 30%. Whereas once you go beyond that 30%, you can start to see with credit card debt, now when you factor in totality all the debt, whether it's car loans and everything, your entire debt picture, what's going to carry the most weight, negative weight, is going to be credit card debt because it can be discharged to a bankruptcy. So it's always highest risk, and for risk modeling, it carries the highest negative impact as you go beyond. But it's not necessarily card by card. It works in totality. I know that sounds a little fuzzy in trying to explain that, but it doesn't go card by card. It will look at total revolving debt, all credit card debt in totality, not card by card.
Great. So that's going to conclude our Q&A session for today. Thanks everyone for sticking with us a couple minutes past. As a reminder, if you have any further questions, Todd's information is up on the screen. Feel free to reach out to him directly, or you can email me at events@gecreditunion.org, and I'll get that question over to Todd for you. And with that, thank you all so much for joining us today, and we hope you have a great rest of your day.